We are past the halfway point and back with more pivotal change. We're talking about mental strength, surrounding yourself with the right advisors to get through those points where you may have weakness, vulnerability, and really launch your path forward to success as a leader and a person of influence. You got to trust your right set of advisors. Now, something else that really causes a lot of stress and we can use instead as an opportunity to build mental strength is properly preparing. This is the time of the year where we prepare for the year end and we prepare to begin a year anew. So these new beginnings and the closings out of a year, fiscal year, calendar year, whatever it is, I just want to walk you through some points that you really need to pay attention to as an entrepreneur, a business owner, or somebody in a corporation that has high level responsibilities. So let's walk through a little bit of a list and see where you can properly prepare and get things done before it's too late or before it's absolutely crunch time, because you do only have a few days left at this point in time. So one of the things that I want you to do is I want you to sit down and review and update your financial records. Too often people let their finances just get away from them. They're running their businesses just by looking at their bank account. We have enough money to make a purchase. Do I need to send out a bunch of invoices for these jobs I've been forgetting to bill people for? And you need to get on top of your financial records. You need to make sure that you have all of your income recorded. That's pretty important. The IRS and your state is going to think that's pretty important that you have all of your income reported. But for your sake, you need to make sure that you have all of your expenses and deductions recorded. So get those expenses put out there. Know what your actual position is. If you have an accounting software, it should tell you exactly what your balance is, not your bank account, but your actual balance in, for example, QuickBooks or an accounting software that is your functional operational balance for true funds available. Much better, more sound way to run a business. You got to make sure that all these financial transactions are accurately recorded and reconciled, which means you got to clean them up, match them up, and get rid of any discrepancies. And again, softwares are really great. They can really spread this out in an easy to read format and then simplify it in a much quicker way. But professional accounting firms and bookkeepers, they can do a lot of this for you. So just make sure, do like a double check that you have all your invoices, that no client payments have gone unrecorded. There's no receipts that have slipped down into the cracks of the truck. Get those out, help get those plugged into the system. Make sure you have that clear picture of your records as you close out the year, so there's not a lot of surprises on what your net position is, and you know what your taxable liability is going to be, or if you have the opportunity to demonstrate a loss and possibly get a refund. So the other thing is going to be maximize your deductible expenses as well. So you have to go through and check things and make sure that they've been recorded in the proper category, that they're reasonable and necessary, the reasonableness test by the IRS, and they're not technically personal deductions that you need to change over to maybe a distribution or draw account. But there's another thing about making necessary purchases. Every business that I know of needs some type of software, tool, computer, vehicle, piece of equipment, desks, all kinds of stuff to help you run your company. Make sure that you have all of this stuff entered in the system to reduce your overall taxable income. That's really important. Okay, let's give a for example. Let's say you need to buy a new piece of equipment. You're a dental office and you really need to buy this new x-ray machine. If you don't know that your financial records are up to date and you don't know what your taxable position is, you don't know when the right time to buy is. So there are examples of like Section 179 depreciation that you can take and say, hey, I'm going to go ahead and buy this x-ray and I can get a huge upfront bonus for it that covers me for the whole year, even if I bought it on the last day of the year. So if you know your position, you can get those extra deductions at the end of the year and see how badly they're needed. You don't just want to go spend money just in case and buy a new truck just in case to try to reduce your tax liability. So really plan those things and talk to an expert, a tax planner that can help walk you through them. That's a big way to do it as well. Another thing that you can do is contribute to your retirement plans or other fringe benefits that you have. Make sure those reimbursements have gone out. Make sure you've maxed out as much as you can fiscally afford or as much as the limits allow. If you can get your retirement plans going, the sooner you put that money in there into like a SEP, a Roth, some type of solo 401k, those can really help you, and it can reduce your taxable income while securing and planning for your future. So you kind of get to double dip in that one. And here's just another for example. Like if a sole proprietor like contributes, let's say $10,000 to a 401k, right? It can lower your taxable income as a deduction for a fringe benefit and also increase your retirement savings for later on. So you have security and you can withdraw a higher amount during retirement and therefore continue to live, which hopefully 20, 30 years when you retire down the road, you'll be at a higher status, a higher standard of living, and your retirement investments can match that and keep you comfortable. So again, get those retirement plan contributions shot out, going in there. You can do it on the paychecks. You can do it on the payrolls. There are ways to do late contributions. Most of them allow you to do it till 4/15 the following year. So real time, if you know you want to make a retirement plan contribution, most plans allow you to do it all the way to April 15th of 25. So the best way to do it is to do it now. Don't wait. Don't be surprised. Don't risk missing a deadline, and go ahead and have your ducks in a row. Because if you wait 5 months and the market goes up and up, you're not getting the gains in your retirement savings from those 5 months that you missed. Go ahead and just take care of it and do it now. Now, you really need to evaluate your income timing. And what I mean by this is you need to possibly defer some income to the next tax year or accelerate some deductions so that goes back into whatever your financial situation is or whatever your expectations of the future. Are you a seasonal employee or a seasonal business that gets huge spikes of income during the summer, or you do snowplow and you get huge spikes during the winter? Planning your needs and planning your income and how to make sure you pace out the timing of that income. For example, the historical model of an accounting firm would be to help people throughout the year. You're going to have some planning. You're going to have some tax work throughout the years, bookkeeping, whatnot. But you get a huge spike of income in the months of February, March, big time April, and then May when you do all of your tax work and then you bill for all of that work. So you get 3 really good, huge months of income. And most accounting firms make 60% or more of their total revenue for the year in those 3.5 months. And then they trickle out somewhere between 40 and 20% left over for the rest of the year. Well, for the average tax factory, which we try to teach people not to be, you may be running really thin towards the end of the year when a lot of your subscriptions and renewals and taxes and property taxes come due when you made all of your big money March, April, and May. And you probably lived high in the hog in June, went on a nice vacation, but now you and your employees are starving. You're looking at how to make payroll, taking out lines of credit. You don't want to do that in any industry. So the timing of your income is important. Evaluate that again. Look at historical markers. You should have clean financial statements so you can look at percentage of changes, dollar amounts of changes, and hopefully have an advisor helping you through. You need to save this much. You need to put this much here. You can even budget, get budgeting planners, wealth advisors. There are a lot of people that can really help you this, and you need to understand that you don't have to fight this battle alone. So that timing could be really important. Here's another thing. If you have a huge job, we have a construction client that only does bigger jobs. They do road construction. So they'll do several jobs for, we'll just say, lots of zeros at the end of it. But in particular, they had a massive year, good year, and landed a gigantic job right towards the end of the year. Well, you can simply send the invoice or collect that money appropriately, depending on if you're cash or accrual system. But in this circumstance, they just deferred collecting that income till January because they were going to absolutely get killed on income and taxes already. And then just exponentially, it seemed like they were going to have to pay more taxes if they were just to receive that money a few days earlier and not push it into the new year. All appropriate techniques based on when you sign the contract, when you deliver the funds and start executing on the actual work. Again, look at your advisors, look at your plans, look at your laws. But people know these things. And then the other thing that you would want to do is conduct a tax planning meeting with professionals so you can get an estimate for the end of the year. You can understand what your liability position is. No surprises. Know exactly where you're at. And then don't do anything crazy that they didn't tell you about. So get that understanding there, and they can give you some of those suggestions and tips on how to get some more exemptions and deductions. But we want to ring in the new year as well. So I'm going to rattle off a couple of ways for you to prepare as a business owner to begin your new year. What considerations and action plans do you need to put up? Well, based on everything I just talked about, you should have really good financial information to set goals and budgets. And when I say set goals of increasing revenue by 10 or 20%, you need to put markers on the calendar. It says check revenue, check sales, check this goal, check training, check the software system, and go back and hold yourself accountable. You also have to keep solid organization of your tax documents and your records, because even though the year has closed, tax season isn't for a couple of months. So all of those 1099s, those W-2s, they got to get filed and pushed out. They got to get received and given to your tax person. All of those expenses, all of those receipts, those brokerage statements, be organized, get it gathered together, create a folder, preferably both physical and digital, and give it to your accountant in a timely manner so they can help you. Help them help you. Update your payroll employee benefits. Almost every year, you're going to have employees come and go. Somebody may get pregnant and have a child and therefore have a different claim they want to do on their W-4. Somebody may have had the loss of a spouse or a loved one. You may have hired and fired. The payroll laws may have changed. Minimum wage may have changed. Get those new forms filled out. Reevaluate the fringe benefits, reevaluate the insurances and the dental plans, and set a calendar date for that and have an enrollment period and get that going. You will be clean, organized, the people will have better, higher morale, and they'll be taken care of. Another one that's really important is plan any major business investments. If you have like a huge conference you go to every year, slide the money over for that, get it set in place, get all the bookings put in place, and really start planning. If it's a capital investment, you know that, hey, we're going to have to build a whole nother series of garages for our expanding fleet. Get the money going, get the loan ready, get the financing discussion discussed, have your down payment ready, start and get ready to break ground from day one. Plan that as early as possible. And then again, I'm going to be a little redundant, but you need to schedule another tax planning meeting with professionals. They're probably not going to meet with you really hardcore in February, March, and April, but starting in late April and May, sit down with them and look at the year to come. Have them be forward-looking professionals. Tell them about your goals, your dreams, the entity types. They're going to know what is right for you, and your advisor is going to start suggesting things like quarterly meetings with them. Maybe you're doing so well, you need to make quarterly estimated payments. Maybe your reasonable compensation is awesome. You need to move things, write bonus checks, introduce new fringe benefits. What I am telling you, more than anything, is to be prepared, get an action plan, go listen to the 10 things that I rattled off, write them down, review this episode, and then take action. Sit tight. We're going to have one final segment of the show. We'll be back after this to close out this episode of Pivotal Change.